If you're thinking of buying an investment property, you're on the right channel to gain information. Hello, welcome to Ring of Knowledge, where we will advise you on how to make smarter real estate selections. Wait until number 6 to learn how and why it's crucial to track your expenses and debt. So, let's get started. Property is one of the most secure and valuable investment options. It does not carry the same level of risk as stocks or cryptocurrency, nor does it involve a large investment. During an economic downturn, real estate is less affected than other types of assets. This is because the consequences of economic sluggishness vary depending on the sort of property you invest in. Hotel investments, for example, are riskier than office building investments. There has never been a better time to enter the market as an investor and expand your property portfolio. But don't allow the excitement to blind you to a few critical elements. Here are the top 10 things you should know before investing your life savings in real estate. Number 1. Determine your long-term objective. Property investment does not provide instant gratification. Instead, it is a long-term investment that involves long-term thinking on the part of the investor. To maximize your money, you must first establish a long-term goal and stick to it. An investor should let your home mature and acquire value over time. After all, you want to maximize the financial appreciation of your investment, right? Rental gains might also create passive income from your property. The higher the worth of your property, the more rental revenue you will receive. Whatever you intend to do with your property, be sure it remains consistent with your long-term objectives. Every decision you make in the investment process should be guided by your goals. Number 2. Conduct research and evaluate all key factors. When purchasing an investment property, location is critical. Choosing a location or neighborhood that is likely to have affordable prices and yields in the future is, of course, a wise investment approach. However, simply considering the price index is insufficient. When choosing a property location, you must consider various other important factors, particularly the supply index. Unfortunately, many first-time investors forget this issue in their excitement, but it should be a critical component of your decision. The provided index is very important when evaluating growth estimates in your chosen sector. For example, a town's growth prospects may be great, but do they extend to your property sector? As a result, selecting an area where rental property demand exceeds supply is preferable. This entails purchasing a built-to-rent property in places where inhabitants have few options in comparison to the population size. This assures that your property will be in high demand among local tenants and that your earnings will be steady. Number 3. Seek advice from a financial advisor. While it is important to conduct independent research, it is also critical to seek the advice of a financial counselor. These experts are well-versed in all aspects of real estate investment. You can be honest with them and ask their advice in areas where you are stuck. A qualified financial advisor will offer you 24/7 support to help you make the proper decisions, whether it's about taxes or the dangers involved in the process. However, before selecting an advisor, make certain that they are the greatest in the field. Only the best can provide you with a clear picture of your objectives and reasonable investing expectations. Number 4. Remain current on recent tenant trends. Consumer and market trends shift throughout time. Knowing about the most recent ones can help you make the best decision in terms of sector and location. Keeping up with emerging trends also allows you to make the necessary improvements and upgrades to your property in response to tenant expectations. It also allows you to create effective investment strategies that maintain your property marketable. During COVID-19, for example, numerous new tenant trends emerged. People began to favor residences that are not overcrowded and have all of the necessary healthcare facilities nearby. They also prioritized the creation of more outdoor places. The concept of collaborative workspaces has also become ambiguous, with more people preferring social isolation and working from home. This would have been a huge issue for you as a commercial property investor during those years. As a result, as an investor, You must understand what tenants desire to retain them in the long run. It will also provide you with a competitive advantage. Number 5. Do not let your emotions control you. Since purchasing a home, most people listen to their hearts rather than thinking logically, which is completely great when it's in the location where you will be living for many years of your life. However, don't let your emotions influence your decision to purchase your first investment property. Consider it solely a business investment and bargain logically to achieve the best possible price. Let us now discuss the financial aspect and the thought process involved in dealing with finances. Number 6. Obtain a down payment and think through the expenses required. In contrast to the 3% down payment on your present home, you will need at least a 20% down payment on your first investment property. This is because mortgage insurance is not available for investment houses. Furthermore, investment properties have higher down payments than normal buildings and severe approval criteria. Before you make your down payment, consider the costs of the renovation. Number 7. Plan ahead of time by calculating expenses and revenues and creating a reasonable budget for yourself. Only the paranoid survive, as the saying goes. Okay, not always, but there's no harm in being a little paranoid and planning out every aspect ahead of time. Before purchasing your first investment property, figure out how much money you already have and how much you can borrow. Next, figure out how much it would cost to buy and renovate the house. Also, consider the operating costs. Finally, estimate the price you will offer your property for and subtract the expenses to get an idea of the return you can expect. To be honest, you may not even make half of the predicted profit, but this calculation is required to keep yourself safe. Set a reasonable and practical budget for your real estate investments and stick to it until the finish. Even if a house appears to be the one, but it is out of your price range, don't overextend yourself to get it. That is the most common error made by new investors. Only look for residences that you can afford to avoid future financial troubles. For example, if you aim for a property that is out of your price range, you may find it difficult to keep up with your repayments while still managing the property. You must also be prepared for any unforeseen decrease in the property's value or market performance. For instance, what if you need money right away and your property hasn't sold for the amount you expected? Can you live without a rental income for a few months? Answer these questions in the comment section below to share your thoughts. When you stick to your budget, you can make room for all of the property's hidden costs. This will lessen your financial strain while also increasing the efficiency of your assets. Number 8. Arrange debt payments. One shouldn't have debts in their investment portfolio as a novice investor purchasing their first rental property, so you may need to think about investment loan possibilities. Before investing in real estate, you must pay off all of your debts, including any college loans and medical expenses. Number 9. Examine your choices for investment loans. When it comes to getting the money to buy your first investment property, you have a lot of options. It takes a lot of research to select the best choice that could improve your financial status. The greatest investment loan option for you will depend on your circumstances and will have a variety of rewards. However, you must take into account aspects like which loan choice gives you the ability to divide the credit, or whether it offers you a line of credit facility. Number 10. Pick your partners wisely. Instead of taking out an investment loan to get their real estate investing career started, many people think of teaming up with their pals. When choosing partners, first-time investors should carefully evaluate several aspects, including how comfortable they are with them and the ramifications of a partnership agreement. Given that you people watched all the way through, here are a few extra tips. Number 1. Pick a modest house as your initial investment. It is usually a good idea to choose properties that fall in the lower to mid-range price ranges, even if you are willing to pay up to $1 million for your first investment property. Some professionals advise choosing a home that won't set you back more than $150,000. Don't forget that the house needs to be renovated before you can rent it out or sell it. Keeping your investment as little as you can also helps you stay in the safe zone, since it is your first investment property. You won't run the risk of losing a lot even if the profits are lower than planned. Number 2. Negotiate. Buyers cannot be fearful during a real estate transaction. They have the money, and they have a say in determining the exact value of the property and how much they are ready to pay for it. It is usually a good idea to haggle the price before purchasing and not simply accept the amount quoted by the seller. Negotiating is a skill, and real estate businesses and brokers can occasionally assist with price discussions. Number 3. Be picky when purchasing. Regardless of the sort of item purchased in the market, purchasers rarely choose the first option. This means that ladies, for example, do not purchase the first clothing they see, and that people in general do not purchase the first car they see on the road. Similarly, in the real estate market, it is not advisable to purchase the first house that is shown to a buyer. Number 4. Fees for agents. Buying a home in a real estate market, especially for the first time, is a difficult task. Many purchasers use escrow companies, brokers, agents, and middlemen who are familiar with the industry and the area to ensure a seamless transaction. These intermediaries show purchasers the greatest residences in the neighborhood and assist with price negotiations. When settling on a budget for purchasing a home, it is always a good idea to consider the agent's fees. Property investment is an excellent strategy to increase your wealth. It is a long-term process that will benefit you for many years. For example, you may buy an investment property and rent it out to generate a consistent monthly income. Investing in real estate, like any other business, may go either way. You could make a lot of money, or it could be a disaster. If you follow wise recommendations and play it safe from the start, you will almost certainly come out on top. However, as exciting as it sounds, you must examine a few critical things before making a decision. Before you begin, always consult with a financial counselor. Then, set your goals, create a budget, select the best property type and location, analyze all essential criteria, and remain current on market trends. Also, never be scared to invest in real estate during times of economic turmoil. If you're interested in this type of content, please like and subscribe to our channel. Thank you very much.